Okay. Good morning. Thank you for joining us for today's coffee talk session. Again, my apologies for getting the webinar or the Zoom call started a little bit late. My name is Sean O'Brien, the president of Quick Rate. And as always, I'm pleased to be joined by Steve Huntington. Steve, do you want to go ahead and introduce yourself?
Sure. Thank you, Sean. My name is Steve Huntington. I've been spent my entire career working with community financial institutions on everything from strategic planning, capital planning, valuation, and M&A advisory type work. For the past decade or so, I've been working very closely here with Sean and taking a lot of those tools that we've built in the industry and putting them into an analytical platform that is a lot more accessible and efficient for credit unions.
Great. Thank you, Steve. And today we are very pleased to be joined by Paul Allen. Paul Allen is with Saltmarsh, Cleveland and Gunn, an public accounting firm based in Pensacola, Florida. Paul has been a longtime friend to both me and to Quick Rate, and really are thrilled to have him on. He will raise the level of discussion today. And Paul, if you want to go ahead and introduce yourself, it'd be great.
Well, I don't know if I can live up to all that, Sean, but it's an honor to be with you and Steve today and talk about how institutions can move through implementation of CECL. I know this has been an interesting time watching the large institutions implement that, and now it's our turn. So I'm very, very interested in the conversation and the questions. So thanks for having me join you.
Thank you very much, Paul. So as we mentioned, again, one of the reasons we, started these coffee talks was one, to have a gentleman like Paul on here to join us, share perspectives as an auditor and a third party looking at CECL. We understand not only in our development of our tool, we wanted to create in many ways a user group that you could come to, ask questions, and feel like you have some ongoing assistance or way to make sure we get to the finish line with CECL in the most pain-free way possible. So we introduced these so that we could, one, still provide a way to introduce what's new in the CECL solver, what people are problems that may be encountering, but then most importantly, again, get to your questions. So today, as always, and we want to welcome those who are attending their first coffee talk, and certainly say thank you to those of you who are on a repeat attendance. To participate, probably the easiest ways are to either click on the Q&A box or on the chat feature and submit your questions, and I will be monitoring those throughout the presentation today, and we'll take those either during the individual sections, or we'll take those at the end. So rest assured, if you put it in there, we're gonna get it addressed. Again, just we've kind of touched on these. We understand that for many of you, there's been a lot of talk about CECL. We've been talking about it for a long time. We not only wanted to give you an extra way to address questions, but also for us to communicate any changes or enhancements that we're making due to feedback we're receiving from you, our users. And then, like I said, in today's instance, bring on an expert like Paul to share another point of view as we try to, again, take the mystery out of CECL and the transition that is fast approaching. So I'm going to turn it over to Steve at this point, just again, for those of you who are new, just to give you a quick overview of our CECL solver solution. Steve?
Thank you, Sean. So again, for those of you who aren't familiar with how our tool works or haven't seen it in action yet, the first time that you log into our tool, it is really designed for you to be able to get some actionable results kind of, I would say, almost right out of the box. The reason we're able to do so is that we start our initial loan segmentation with all of that rich universe of data that we can get from those Form 5300 call reports that y'all have been having to file every quarter. I'm sure you're busy dealing with all those changes to the call reports that we have this quarter, and that's something that we're actually going to talk about a little bit more in a couple minutes. But we take all that data, and so the first time you log in, you'll have a complete history of your balances, your charge-offs, past dues and recoveries by segment, going back in time as far as we need to. But as importantly as having that data sort of preloaded into the system, we also have all of that same data for all of your peers. And we'll talk again in a couple minutes why that apples to apples segment level historical experience from your peer group can be so helpful, especially in an environment that like what we've been in recently, where so many credit unions like yourselves may have entire segments that have almost no loss history or experience within a reasonable look back period, and how helpful it is to have some more good segment level environmental data to really support those necessary qualitative factor adjustments. But our tool is based upon what they call the weighted average remaining maturity, or the WARM method, certainly one of the more straightforward methodologies that's been heavily discussed and vetted and approved by auditors and regulators for complying with CECL, depending upon the size and complexity of your institution, certainly. Using the WARM method, we start by doing some remaining life calculations that we can help you with. And once those are into the system, the tool is really goes off and running and takes care of a lot of the number crunching for us. One of the other benefits of our particular platform, in addition to having all that data preloaded into it, so you really don't have, there's no ramp up time to kind of get up and going, is that it's truly interactive in nature. One of the problems or challenges that we see a lot of our customers having, especially credit unions like yourselves, is once you've built an entire, spend a huge amount of time going through all the assumptions and inputs and have a scenario for CECL. And then you look at that bottom line, what is that ACL that comes out at the end? And it's wildly different from what you might had hoped or imagined it might be. And you have no idea exactly what got it there, right? Or on an alternative situation is you built a scenario, you understand how it works, and then you come in next month or next quarter to update it, and the numbers are wildly different than they were the previous month, but you have no good tool that really lets you know how you got what made such a big difference. And I think it's a huge challenge depending upon what system you're using. That's really not an issue at all, I can say, with our tool, because every time any assumption or input is changed or altered in the tool, the entire model recalculates completely from top to bottom, pretty much instantaneously within a second or two. So when you change an input, you can see exactly what impact, what effect it does or doesn't have on your segment level ACL and on the entire reserve calculation. So it makes it much more efficient in kind of zeroing in on what assumptions, what inputs really move the needle, and which ones do I not really need to spend very much time kind of sharpening the point on, because no matter what we use, it doesn't really impact the end result. Our tool has one more second. Our tool has an increasingly robust system now for managing qualitative factor adjustments, something that we're going to be enhancing even further, which we'll talk about in a few minutes. It also has an area for you to manage any individually assessed loans that we feel would need to be sort of culled from the herd and managed on an individual basis. If you can go to the next slide now, Sean, as you build scenarios, it's very easy to save a scenario wherever you're at. It gets saved securely on the cloud. You can access your scenarios anytime you want to. You can have multiple people accessing them and working on them together. You can save as many scenarios as you want. And then when you're ready, you can certainly export the tool into whatever format you see fit, whether it's a PDF, whether it's Excel, and choose exactly how much of that data you want to share depending upon your audience, right? If you need a quick and dirty output report for your board, you probably don't need all the nitty gritty. If you are sharing your results and your justification of your qualitative factors with your auditor, I'm sure they do want all the nitty gritty. So you have some flexibility there in your exporting functions and features, and your peer group choices as well. Sean or Paul?
Well, I just wanted to point out, if you go back to that previous slide, it warms the auditor's heart to see some of the features there on the right side, the user notes. One of the things that auditors and examiners are really focusing on is not necessarily questioning your assumptions or your Q factors. We'll be asking for your thought process, But to the extent that as you develop a scenario, you can take notes on the side to document your thought process. That's very, very helpful to the auditors. And so they will want to see that. And then I just want to compliment you at the top right hand. There's some additional resources there that are just going to be increasingly important as you document to regulators and examiners your thought process and so forth. So we all focus on what should my Q factor be and how should I segment my portfolio. But what's really going to be significant in terms of taking time for the CFO or the individual doing this is actually documenting their thought process so that it can be told and shared with auditors and regulators. So I do really like the fact that you've got some additional opportunities there for the users to document not only just the model results, but actually what their thought process, what a difference in a scenario might be, and so forth.
And those documentation, those notes get attached to the segment as soon as you make them. So when you save a scenario or export it, they get organized and it creates a whole separate page where it shows you the documentation at the segment level. If you're updating your tool a month or a quarter from now, and you kind of want to roll back the clock and see, hey, what was I thinking about this exact adjustment last quarter, and how do I need to change it for this quarter? It's extremely efficient and easy to do using our tool.
And Steve, I think we get as many questions on how should I document my process as we do with, how should my segmentation be, or how should I deal with impaired loans and so forth. So that's a huge issue that we can't forget about. The documentation is critically important as you move forward, especially in this first year.
That's awesome. Thank you. So Steve, if you want to just maybe share, again, some of the tools that are now available to all.
Yeah. In addition to the CECL solver tool itself, we decided it was time to start sharing with you guys some of the other data that we've always been capturing on credit unions in a way that can sort of help you look at your financial data historically, help you compare it to peers over time. So in addition to the CECL solver tool, everybody now has access to these financial reports on your credit union or on any other credit union in the country. So if you search for a credit, you can now go to our tool, log in. You can search for a credit union and you can see all of their summary financial data on a quarterly, on a year-to-date, or on an annual basis, going back as far in time as you see fit. You can compare it to the peer groups. You can look at their branch footprint. On the next slide, Sean, you'll see we have another tool that allows you to just do some quick comparisons and some peer filtering. If you were curious as to, when you're running the CECL tool, one of those peer groups you might use is, well, we're a $200 million credit union. So we're in what the NCUA calls peer group 5, right? 100 to 500 million in assets, and we're in California. Who are we really comparing ourselves to? Who are the other 100 to 500 million dollar credit unions in the state of California? This tool we call the Credit Union Universe at a Glance. It just takes some of that same financial data that we already have access to, and it just sorts by your state or your region, and you can just see all the credit unions that are around you in your neck of the woods, and you can sort by asset size, by performance. If you click on any one of those credit unions, it'll take you right to their homepage and show you all their financial data and their footprint and everything else. And no additional fee. That's just something that we thought, since we have access to it and we can build stuff like this, that we would do it and just offer it as an extra benefit to our customers.
Great. Thank you, Steve.
Cool.
Just as a follow-up, again, just tried to make it easy to navigate and just put as much information as we can at your fingertips. So again, I think, while we've designed the CECL solver to, again, capture what we think helps best, think about your historical losses and give you a way to think forward. Q factors always come up as something that, presents some challenges for some credit unions as they think about their reserve. And so we thought we would, cover this topic because we have Paul on and he can share some of the experience and insight, that they have at their firm about how best to, kind of handle these Q factors. As many know, right, there's a handful of common Q factors that are utilized. that have been interagency policy guidance. And Paul, do you want to just kind of touch on how your thoughts and what you see as best practices with Q factors?
Sure, Sean. Probably one of the biggest, I'll say, myths or misunderstanding is that because we have these Q factors listed in the guidance that everyone refers to, that every one of them has to be used for every one of the buckets of loans or segments of loans. And that's simply not true. These are great, well thought out suggestions for Q factors, but you could have additional Q factors that are unique to your institution, your product mix, your geographic market, and so forth. But most importantly, you do not have to use every one of these Q factors for every layer or segmentation of your loan portfolio. There may be some portions, for example, automotive loans. Traditionally, if we look at what drives the loss in automotive loans, it's probably a couple of economic indicators like unemployment, for example, in other words, how the domestic local economy is doing. And then perhaps the value of the collateral. You know, was this did we lend 115% of the purchase price up front, or was it a 50%? So you might pick that those two are the most significant Q factors, and you may say that those are the ones that actually trigger losses. In other portfolios, member business loans, you know, commercial real estate type loans, probably most of those Q factors, you know, will probably apply, but you do not have to use the same Q factors or all the Q factors. The whole intention is that you know the risk and the makeup of your institution's loan portfolio. And so these are the tools you have in the toolbox, but you don't have to use every tool for every situation. And that's been a big misunderstanding. I think that people felt a pressure that I have to use these particular ones, but these are well thought out, and I think they're a wonderful list, and I think you should consider them. But I would encourage you not to feel pressured that you have to use each one of those. Steve, is that a
Yeah, I would. No, I think that's very well stated. And just as an aside, I would say when it comes to the collateral of used vehicle loans right now, it's looking pretty good. I know. I know. I've been considering selling a 2010 Suburban, and it's gone up about $6,000 in value in the last 4 months. So I'm excited about that.
Yeah, absolutely. Absolutely.
And thank you, Paul and Stephen. Again, I think that's really one of the things that I think we try to remind, you know, every credit union is, you know, there isn't one way to do this. Sometimes we can set artificially arbitrary or higher bars for this. Even as Paul mentioned, right, you know, different auditors might even see the world differently. But I think ultimately the most important thing, again, and Paul touched on this, is you understand your portfolio better than anybody else. And so, you know, there's obviously components or factors or things that keep you up at night that you know will impact your members in the future, and then there in turn your portfolio. And so having, you know, a handle on those, monitoring those for any directional change or movement, you know, again, I think are the types of areas where we have the expertise to do that. Like you have that expertise, you know, your members, you know, your loan portfolio, you know, really focus in on, you know, the things that again might keep you up at night. And again, that kind of just dovetails into this, right? That you've invested in a process with your Q factors. It's a process you have comfort with, your board does, you know, typically your auditors and your regulator do as well. And so that's valuable. So don't discount that. You know, again, I think we spend a lot of time thinking about potentially trying to correlate economic activity to losses and this and that. And, you know, that's an exercise we can go down a pretty deep rabbit hole on, and I'm not sure you really get instructive information, but you know, it is a subjective process. So I think throughout all this, and Paul and Steve have already kind of touched on this, you know, documenting your process is critical, particularly with your Q factors. But Paul or Steve, I don't know if either one of you want to just share anything about even trying to attempt to correlate, losses to any type of economic data.
Yeah, I mean, or Paul, if you want to jump in
No,
there.
go ahead.
Oh,
Go
yeah.
ahead.
So it's something that I've kind of touched on before. Some of you might have heard this in the past, and many of you haven't. We saw in the industry a couple years ago some significant increases in reserves, specifically for things like mortgage loans. The reason that was done was specifically because of past correlation in past downturns between things like unemployment rates and mortgage losses. Unfortunately, just because there was a correlation between an economic trend during the last downturn and a loss pattern that you had does not suggest that it's really going to have the same correlation during the next downturn. So how predictive they are is very questionable, right? The mortgage loans is a perfect example. If you looked at your mortgage loan losses during 2009, 10, 11, I'm pretty sure that you had a high correlation between them and unemployment rates in your state. If you were to then project that forward and in 2020 see a similar spike in unemployment in your state, unfortunately, you did not see any correlating losses in your mortgage losses because the driver of that earlier recession was the collapse in the housing market. So obviously it was related, whereas the driver of the last spike in unemployment rates specifically was a worldwide pandemic that ended up having absolutely no impact on mortgage losses in the industry. Now, of course, governmental intervention played a role in that, but that's also something we could not discount happening in the future as well. So while certainly there are some economic trends you feel can be somewhat predictive, it doesn't always turn out it's not that clean.
That's a great point, Steve. When we talk about the Q factor related economic conditions, if you step back and just think, what are we trying to accomplish here? We're really trying to accomplish saying, over the period that I'm looking back, here's my historical charge-offs, my historical losses. And I'm trying to say, well, what's different between that experience, if anything, and my current conditions? In other words, have I changed my mix? Have I changed my policies? Has the economy, have drivers that have caused losses changed to today? And then we have an opportunity under CECL to look forward over the remaining estimated life of our portfolio. What could change in the future? But Steve, to your point, if you remember, two banking crises, I'll include COVID as a crisis, but if you go back to the previous crisis in the financial sector, if we looked at job losses, a very large component of job losses was anything in the construction industry. We had whole communities that if you worked in construction or you owned a construction company, the job losses in that unemployment cycle were extremely high, very heavily weighted in construction. But if you roll back and you say, well, let's look at the job losses during the COVID type time frame, and you say, well, we've lost lots and lots of jobs all over the country. But if you looked at construction jobs, they could not keep enough people. And so what changed? Well, the big change was the housing supply, right? So housing supply was tremendously too low. And so the construction, so I mean, if we looked at that as an economic factor for a portfolio, if you were lending to construction type companies and you used the metrics from the previous banking crisis and applied them through 2020, you would have massively overstated your required reserve because, as you mentioned, Steve, not every historical economic metric continues to apply. In other words, there's an interdependence of a lot of different factors. So, that's where the judgment comes in, and that's where under CECL, when you're looking at Q factors, you don't have to consider every single economic factor, and you can weigh multiple factors and say, well, that may have had a correlation in the past, but for whatever reason, document please, for whatever reason, I don't think that correlation exists in either currently or going forward over my forecast period. So That's probably scaring everyone because it's opening such a huge amount of judgment. But that is the point of CECL. We're trying to bring you tools to use your seasoned judgment and your understanding of your own risk profile as an institution. But there is no, one size fits all correlation or metric in the Q factors. You are supposed to be very thoughtful about applying those opportunities to adjust your historical loss factor to what may occur in the future. And so that's the whole point of the Q factors in all of them.
And Paul, that brings up a point. And so just to kind of follow up on that. So again, from your position as an auditor, would you say, you typically, again, you don't typically try to prescribe how a credit union should handle this. You just ask them to kind of show you the roadmap of how they're trying to do that analysis. Is that
absolutely? As an auditor, our job is to determine whether financial statements as a whole are fairly presented, not to come through and say, we think that every single, factor that you have is what we would have picked out. There's a lot of judgment. So I would just encourage those who are implementing CECL at your institution to not have fear driving your process, or that you must have every single factor that you've heard talked about applying to every segment. Rather, we're trying to present tools in the toolbox for you to make an informed judgment about your credit risk. And we're trying to find ways to quantify that. But there's a lot of different ways to do that. And as auditors, it's not our job to tell you that you ought to use 25 basis points here or 200 basis points here. Our job is to say, tell us your thought process, and is it reasonable? And does it align up with what we perceive as, your risk profile as well as your peers? So I encourage, I think people are smart and bright. I love working with people in the financial services industry. I love their passion for serving their members and their customers. You can do this. It takes some thoughtfulness, and the key is the documentation. Just document what your thought process is.
That's fantastic. That's fantastic. Okay, so Steve, do you want to just touch on, to that end, enhancements we're going to try to introduce to the CECL solver in the spirit of this conversation?
Yeah, to that end, in the spirit of this conversation. So what we want to do, you'll notice a couple things different in this. This is just an Excel mock-up. I hope you guys appreciate that. We're kind of showing you a little bit of how the sausage is made here. But what we're going to do with the qualitative factor page is give you those regulatory suggestions. Currently, if you go to this part of our tool, you'll see a couple columns, a column for the peer experience where you can make adjustments, a column for economic conditions, and then just any custom ones that you want to add, right? Currently, there's a limitation, I think, of a handful of adjustments. We're removing that limitation, and we added in these 9, somewhat standardized suggestions from the interagency bodies for qualitative factor adjustments. Again, as Paul was saying, they don't expect you to have a number for every adjustment, for every column and for every row, right? If you want to remove a column completely, you can do that. So if you don't have, if your loan review system, you don't think there's anything appropriate there for any of your portfolio, you can click the little garbage can bucket and remove that entire column. But we just wanted to provide a little bit more structure and guidance and have it be a little bit less kind of completely open-ended as the tool is today. So sometime, not tomorrow or Monday, but in the next month or two here, you'll see these additional columns added by default to the qualitative factor page, which just gives you the opportunity to use them as they are. You can certainly, again, remove some, and you can still add additional custom ones at the end as well. And it'll now scroll as far to the right as you want. You can add as many columns as you see fit. And we're working currently on trying to get them to export in a way that you could still print them out without it turning into a mess.
Fantastic. Thank you. And again, I think it highlights, two things. One, as we've mentioned, many times before, one of the reasons we've done these coffee talks, why we've invited people such as Paul on, but we want to, get other perspectives. We certainly want to get perspectives from credit unions. And so we are constantly looking and seeking input on ways to enhance our tool. And so again, these really serve as a foundation to bring our users together and share any thoughts or insights or suggestions that we can use and evaluate and see if we can't incorporate them into the process. That leads to another. Yes, go ahead.
Can I ask a quick question?
Yeah.
Back on the Q factors page there, Steve, is it I think it's my understanding, the user description, the notes that you put in there, to the extent that you jot down notes about your thought process for those and you save that scenario, all those notes go right with it?
Yeah, so the notes are just an opportunity for you to build that narrative around the Q factors for that particular segment. So you make as many notes as you want for that segment. And then when you save the scenario, you can always come back and access them. Whenever you export or print off or PDF a scenario, it'll take all those notes, it'll organize them by segment and have a separate part of the printout where you can really follow that narrative at the segment level for the Q factors, and then also sort of general segment level notes if you made adjustments based upon, government guaranteed balances or fully share secured balances or anything else. So there's multiple areas where you can build those narratives, and they get organized and exported, and they stay kind of within that. So it's an administrative or organizational tool, but we think it's a helpful one.
I'm sorry, Sean, documentation.
Yeah. Absolutely. I love it. Thank you, Paul. We do have a couple of questions. Would Paul comment on negative Q factor adjustments?
That's the whole point of the Q factors, is to increase or decrease your historical loss rate to get it to where it is, to your current situation, including, when I say current, we also include the forward forecast, what we can reasonably forecast. So we would be surprised if you do not have some negative Q factors.
Fantastic.
It would be plus or minus to, again, this is my historical, this is where I'm going forward. I would expect to have both positive, I would expect credit risk to be going up and going down based on certain elements within the portfolio.
And I think that misconception has come from just where we've been in the business cycle, right? With regards to losses, we've been in a relatively benign loan loss environment for a somewhat extended period of time. So people are finding in practice, they got a lot of zeros, which they're going to have to bump up to something higher than zero, which makes people think that, if you've got a negative, it's either going to be highly scrutinized or seriously frowned upon. But there's nothing in the CECL standard that demands any sort of adjustment up or down, or that down should be any different than up.
Right. I mean, it's hard to imagine a situation where you end up with a completely zero loss factor, that there's no credit risk at all when you add historical plus all your qualitative and you go across to zero. I think if you have a zero reserve factor, and it's not a cash secured CD loan or something like that, that may get some attention. Like, seriously, you don't have any credit risk in this portfolio at all, but individually across that page, I would expect there to be pluses and minuses as you go across.
That's fantastic. A question: how quickly does call report information populate after the call report has been filed, and will auditors expect an updated model on a monthly or quarterly basis? Steve, you want to tackle that one first?
Yeah, first half of it's for me. So we we're working on getting the current balances update into the tool as soon as you filed your call report. The entire universe of historical balance and loss data for all of your peers and for every other credit union in the country, that updates as pretty much as soon as the filing period is done. We've worked hard hand in hand with the NCUA at improving how their technology interacts with ours. So instead of having to wait for 2 months after the quarter end for them to roll out that one huge chunky file that has everything in it, Now we're getting incremental. So as credit unions file their individual call reports, we're able to get that data. And once we've deemed that the peer group is pretty much complete, like, which is pretty much the end of that first month, then we flip the switch and the entire universe of loss data gets updated for that most recent quarter end. Obviously, that means there's always going to be some period of lag between our long-term historical experience and that of our peers, and where we are today in our projection. So that's where, Paul keeps talking about this. It's not just a forward projection, it's current and future conditions. If something's happened in the last 30 days since you filed a call report or since we got peer data, you need to be thinking about adjustments based upon that current differential. So you can build the differential into your qualitative factor adjustments, and you can put your current balance right in the summary. So just because we only get a huge chunk of loss data on the industry on a quarterly basis, that does not limit how often you run our tool or when you run it as of.
And I would just say that, as auditors, we're expecting that, just like we had currently in the incurred loss method, most people run their allowance for loan loss calculation once a quarter. The industry has got this wonderful opportunity to see all this information on peers on a quarterly basis, but we all understand that, it takes a while to accumulate that. But, most industries don't have that information about their peers. So it's a wonderful tool to have. For the most part, most institutions, the first 2 weeks after the month end, they're probably closing out their books and so forth, quarter end, getting their own call report filed and so forth. So it's not a burden to, have that month lag before you get the information. You're probably running that on a quarterly basis. Now, if larger institutions wanted to run a monthly model, then I believe, Stephen, in CECL Solver, you can add over your portfolio balances as of a month end instead of the prior quarter end.
Yes.
The factors, the peer analysis won't change. It'll be the same as the previous quarter. And then you could mechanically change, your factors to come up with a monthly. But again, probably for most institutions, it's going to be a quarterly exercise, just like we do our interest rate risk quarterly, we do our call report quarterly. So it's probably going to continue to be a quarterly, but you do have the opportunity to run that monthly by putting the monthly information in there. And that would be, Steve, as you mentioned, what if there's been a significant change in your market area, economic conditions, significant changes and so forth. You might want to do that. But there's always been, realistically, over my whole career at least, there's always been some time lag between having peer data or industry data or even economic data. There's usually a lag. So we have to always look back a little bit. So I don't think that fundamentally affects the quality of our analysis.
Fantastic. The next question is, do we need to change our ALLL policy starting January 2023?
Yes. Almost all of your policies will have references to how you do the analysis. And so there are probably specific references to the incurred loss method and so forth. So your new policy will have to have a discussion about what you do, what tools you use. For example, if you elected to use CECL Solver, that would be probably in your policy. You'd have some vendor management issues with whatever tools you use that you have to document. And then you'd have to talk about who has access to the model and the inputs, who has the authority to change them. And then at what point is board reporting required? In other words, if you do this on a quarterly basis, I would assume your board, your governance body, whether that's the audit committee or the board or a risk committee, would be getting the report within each quarter. And there would be some discussion about approving key assumptions. That's not a new concept for us. Obviously, we have lots of assumptions in the model. There's certain assumptions that are key. There's probably an approval at least once a year of key assumptions and the way you set assumptions. So yes, your policy is going to likely have to conform to the way that you actually are now doing the allowance for loan loss methodology.
Thank you, Paul. Once you decide which method you want to use for different pool segmentation, can you change the method you are using the next month or quarterly?
You can within some boundaries. There's usually a discussion of any significant changes in the way you're calculating would have to be reported under your board or get approval for that. In other words, just the person running the model, they don't like it one way, they decide to change everything and get a better result, that's obviously not going to be correct. And then to the extent that you have such a fundamental change in the way you are calculating it, that it triggers actually a change in accounting methodology, that may have some other implications. But generally speaking, we are expecting, and especially in the first year of implementation, that management teams would be evolving the CECL approach over the first year, especially as they try the first time and they say, hey, this isn't really doing what we need it to do. It's not prudent, not the quality. So we're expecting some changes as we go through. We would not be expecting on an ongoing basis, once CECL is kind of settled in at the institution, would not be expecting that the management teams would be fundamentally changing their approaches because they'd be at risk of kind of like managing the result. And so you'd have to have a thoughtful process of why you think something needs to change.
That's great. The next question is, I see the warm method being discussed often. Could you explain what some of the benefits may be for some of the other different methods available? Some than others for real estate or commercial categories. Paul, you want to start, and then Steve and I can jump in after that?
Sure. I mean, if you take it to the logical extreme, I suppose you could calculate every single on a loan by loan basis through your whole portfolio, look at the remaining life of that loan in particular, look at the risk profile of that loan, look at what may or may not change it. The idea, though, is that for many of those loans, while an automotive loan may be very different than a member business loan, member business loans that are all in commercial real estate or all auto loans probably are going to have very, very similar risk profiles and the things that would cause it. So using the warm method allows you to take similar risk profile loans and put them together as one loan, calculate the weighted average remaining of that pool, and then project the forecast. Would you get slightly different results if you did every single loan in that pool? Well, yeah, the remaining life would be slightly different in each one and so forth. But most of the risk profile would be the same. So to the extent that you have reasonably similar loan products within each category and the risk profiles are similar, it makes a lot more sense and it's a lot more convenient, if you will, in terms of the data you have to handle to use the warm method. Again, you could go to the extreme of looking at every single loan, but the cost benefit of doing that, because many of those loans have risk profiles that are similar and drivers of loss that are similar, the cost benefit isn't there. So the warm method is a practical expedient to looking at every single loan in the portfolio. Steve, is that a fair way?
Yeah, I would say so. The one thing I would not add, but in thinking about it from that perspective, I talk a lot about the way our tool manages assumptions and makes it very clear what assumptions are being made where and how it's impacting the results. When you get to this, if you have a loan level solution where every single loan is separate as opposed to this pool, you're still having assumptions for each one of those individual loans. So once you've done that gigantically data intensive process, if you end up with a result that doesn't match what you think it should be or it doesn't seem to make sense, you've got to go through 5,000 separate, slightly different assumptions to figure out what's gonna, what went wrong or where it went wrong. And I think it's really gonna make it more difficult to provide that, what you say, the paper trail, the audit trail that led to that result. And so it's you end up with a tool that's very unwieldy and very difficult to really summarize the assumptions that went into the output, at least from my perspective.
Absolutely.
Yeah.
Very much like in interest rate risk modeling, we make assumptions about the average life of a deposit product type and how that will behave in different market interest rates and so forth. Once again, if you did every single loan, as Steve mentioned, I would imagine that if you look down the lines of that, an awful lot of those assumptions would be identical within certain loan types. And so all we're doing is collapsing that and taking it over an average life of that portfolio rather than individually. So again, if you do the assumptions correctly and do the data gathering correctly, you should get to a very reasonable result and improve the precision of the modeling because you're able to look at the whole data a little bit more carefully and really test the key assumptions, I think.
Thank you. And just add, I think the term Paul used of practical expedient, to me always gets back to what are you looking for to accomplish, right? Again, you can do, as Steve and Paul touched on, a ton of analysis and not end up with any better answer. And so the question is like, what are you looking for, from a methodology, right? I think in all of them, the starting point starts with, what do you think the expected losses are in that portfolio, right? I mean, that's what a reserve should cover. And how we get there, it can be accomplished in a number of different ways, but we settled on the WARM method because we, as Paul mentioned, right, we felt like it was a practical, understandable, relatable way to how you've done this in the past, and then could be, expediently done by the credit union. So,
and completely consistent with the professional literature as well, because the professional literature consistently refers to grouping things of similar risk parameters or risk characteristics. So completely consistent with that.
Great. Thank you, Paul. The next question is, if credit union updates their information due to an examination and a revised call report is submitted, is this new call report also uploaded into the program? Steve, you want to take that one?
Yep, that's one of the benefits of the deeper relationship we have with NCUA from a data perspective now is that when call reports are refiled, filed late or refiled or whatever, we don't have to wait and get that whole chunk of data, months later. It should be reflected in the system on a nightly basis. So if refilings should be caught in a matter of days.
Fantastic. Next question is, we are seeing a large amount that we need to expense once this is implemented. Is there a way we can book some expense now so that we don't get hit with an allowance, with all the allowance needed for next year? Paul, you want to tackle that one for us?
Boy, that is a delicate one, Sean. There's been lots and lots of comments from the heads of the regulatory agencies that, suggest that we can't manage our earnings or the old way of cooking the books or things like that. So while we're under the incurred loss method, we're supposed to be booking the reserves that are required under the incurred loss method. I will point out to you that in the whole industry, we have seen a significant increase in the so-called unallocated reserves. In other words, reserve levels that are above the actual required on the quarterly analysis that we currently have. And there's been a lot of, speculation that institutions are kind of letting their reserve build as we have this great credit quality environment where we're having no losses, that we're continuing to let the reserve build sort of in anticipation. I will point out to you that once you implement CECL, on the day you implement it, any adjustment to the reserve in the day you implement it goes to the equity section and does not go through earnings. So it's a straight shot to net worth or equity on the day you implement it. So in theory, please discuss this with your external auditors. But in theory, on January 1st, if you are implementing on January 1st, any difference between the way you calculated incurred loss method reserve requirement on 12/31 and the way you run that under the CECL solver or under your CECL application, any difference in the required reserve compared to your GL would be an adjustment to equity. And then in January, February, and March, when you ran your next quarterly in March, any adjustment for the portfolio and the activity and the growth or any change in economic conditions and so forth for that first quarter would go into earnings for the first quarter. So there is a difference in day of implementation and the first time you run the model in the first quarterly period after implementation. And that second part would go through earnings.
That's been my exact understanding as well. That the day one is a balance sheet transfer only, and then day two and beyond it flows through the income as provision. So Paul, my understanding is what we've seen is increases in unallocated reserve. We can call them the rainy day fund collectively is increasing. We're just not saying that the rainy day is due to CECL.
Yeah, so in fact, if I saw board minutes and said, hey, we've got more in the reserve than we need, but we're going to leave it in there to prepare for CECL, I would gently put my arm around that person and say, I would not say that in my board minutes. I would say we're leaving that reserve in there because we're concerned about economic uncertainty, Russia, Ukraine, China, Brazil, India, whatever you want to call it. But I would not do that. If you sit down with your external auditor and you have a conversation about that you have too much in the reserve, it is really a discussion about, how much unallocated can I carry and not get into trouble. And that comes down to a materiality threshold for your institution. But let me be real clear. The party line, the regulatory line, the guidance of GAAP is that while you are under incurred loss method, you calculate and record your reserve and your provisions under that method. The day you adopt CECL, any adjustment that's required, by the way, no one's expecting the reserves to go down in that adjustment. That will raise some eyebrows, but any additional amount in there would go through the equity section. So there's an old Southern saying, Sean, that pigs get fed and hogs get slaughtered. If you overdo it and you're unallocated, there may be a day of judgment coming for you to have a discussion with your auditor or your regulator. But I will acknowledge that there are higher levels of unallocated reserve in the industry right now than there were a couple of years ago.
That's really helpful. Again, I would encourage any of you, if you have questions after that you do want to talk to an external auditor, give Paul and his team at Saltmarsh a call. The next question is, does your system only offer the warm method, or can you look at every method in your system? No, we are a warm shop. Steve, anything you want to add there?
Nope.
Okay. Next, within the warm methodology, what is the most efficient means to collect CPR rates on the various asset pools that don't necessarily have deep data readily available? Steve, you want to take a stab first?
I'd like Paul to take a stab because my stab is a lack thereof. So I've found the end of the internet looking for good industry data on prepayment rates historically. And while there certainly is data on prepayment rates when it comes to mortgage loans because of the mortgage-backed securities industry, that same level of detail doesn't seem to exist out in the ether with other loan types. And for instance, for a lot of credit unions, they're going to have enough trouble just getting through their loan data to calculate warm levels, right? Then going and trying to do larger studies that do prepayments if you're not getting any help from your core or your ALM, which I know many of you on the call don't expect to get any help from them on this, and so that doesn't surprise me either. That where are we going to justify what prepayment rates we use, because they can have a very significant impact on remaining lives, right? If you think about if you have a portfolio of nothing but 30-year mortgage loans, right? The remaining life of those loans should be somewhere in the 15 to 20-year range, right? If you have a normal kind of curve or distribution of loans coming on and off the books. However, we know intuitively that the typical 30-year mortgage loan doesn't live for more than 7 or 8 years from birth to death, at least in the last decade or so. And so how do we get from a 17-year unadjusted prepayment unadjusted warm to a 5-year prepayment adjusted warm for mortgage? And that's that prepayment level of 10%, 20%, 30%. And well, like I said, there is some data from the mortgage portfolios. There's not a whole lot in other areas of the portfolio. I'd be interested to hear Paul's thoughts on that.
Yeah, that's exactly right. I mean, there's lots and lots of ways to, you can hire, there's a variety of analyst firms that will come in and do either a deposit study or a loan prepayment study on your historical background. The caution I would have in that, though, is if you looked back over the last 10 years, is that a good proxy for how, for example, your mortgage loans or your automotive loan portfolio, is that a good proxy for going forward? Well, in the last 10 years, we had rates consistently falling. So lots and lots of refinance opportunities, a lot of disruption, if you will, in job placement and so forth. COVID happened, the banking crisis happened, just immediately previous to that. So even if we get perfect data looking backwards for prepayment rates, we still have to jump and say, well, is that going to be the future prepayment assumption? And so, so it becomes extremely difficult to do. I think most people starting out will use some rather broad kind of thought process. Steve, most of my career, 30-year mortgages had an average life of 8 to 12 years. I mean, that's been a kind of a rule of thumb. Now, certainly that has peaked and gone back up and down. On the securities portfolio, you could look at MBS for mortgage and use that as a proxy if you wanted to do that kind of a process. But I don't think that in the first round of CECL, getting perfect prepayment risk metrics is going to be the primary focus of getting the model implemented. I think you're going to have to make some general assumptions and then monitor that. Even if you do your own loan prepayment study for your institution, you still have to make the bridge of, is that a good proxy for going forward? And then I don't have that information for peer. So mortgages are pretty well known. Automotive loan lives are available in a variety of different studies as an anecdotal or a general metric, but I think it's going to be a really high burden for you to come up and set individual CPRs or lives going forward on each individual category of your loan portfolio. You're going to have to take a guess and move forward, and that's okay. Again, I'll go back to what Sean was saying. We're trying to make sure that the reserve for the whole portfolio is reasonably adequate and you've documented your thought process. So I would encourage everyone, I mean, you can use all of your time in trying to get ready for CECL in focusing on individual assumptions that may take an inordinate amount of time, but don't move the needle with respect to, is the reserve adequate? So I would walk before I run. I would kind of keep it simple, keep it straightforward, moving into implementation. We're expecting in the first year that as you go through the first year or year and a half, you refine and enhance the model, but we've got to get started somewhere. So
that's great advice, Paul. Thank you. The next question is, on average, knowing that each credit union is different, what are you seeing in terms of the day one hit as a percentage of the ALL? I mean, I'll take the first go at it again. I think that's the important part, is every credit union is different. I also think it, I think it's varied by, oftentimes just, experience or even the same auditor. I mean, part of it's a comfort level. And again, getting back to what's the appropriate level of reserve. I think there's certainly some credit unions that we've seen who have been traditionally under reserved, given the shorter look back for the incurred loss methodology. I think some will certainly see an increase for CECL. On the other hand, I think there's plenty of credit unions who have had an adequate reserve, today and probably won't see much of a change. So I think it, again, gets back to, if you've done something where you've been on the lower end, certainly compared to peers, or something that's lower in comparison just to your annual charge-offs rates, just the very nature of CECL looking at losses over a longer period of time, it's gonna tell you need a bigger reserve.
Yeah.
And so I think some of that you can just kind of see right off the bat.
Yeah, and I'll chime in real quick because I work with all of our users on taking a look at how, when they build scenarios, what they look like. And when I say it's all over the map, I truly mean it's all over the map. There's plenty of institutions, credit unions out there that have less in their loan loss reserve than charge-offs they see in a typical single year. Those institutions are likely to have a shortfall, right? Just because of a difference in time period. They're pretty much CECL. One of the things it's doing is it's forcing us to front load our reserves for all the losses we'd see over the remaining life of the loans, as opposed to in any one given year. So if your reserve is not adequate to handle a year, unless you expect all your loans to mature in the next year, it's probably not going to be adequate under CECL. On the other hand, it was just a couple of weeks ago that we had a credit union who's they only do auto loans to Catholic nuns in Wisconsin. I'm not making this up, and they haven't had a loss in like 30 years. So, and their reserve is currently like 90 basis points. So mathematically speaking, they have 120 years worth of average losses sitting in their loan loss reserve right now. They are going to have a hard time justifying it as high as it is, and everywhere in between. So I don't know if I could average it out and say the industry is over or underfunded, especially with credit unions. I see a huge variance.
I think everyone, when CECL first was proposed, we were coming through some pretty high charge-off periods. And so everyone's expectation was that this was going to increase industry reserves significantly. But as we've gone through the last few years, where we've had very, very benign credit risk, very low charge-offs and so forth, I think people have continued. They haven't reversed their reserve requirements as they grew. Even though their total assets or portfolio grew, they didn't take a lot of charge-offs or recoveries. So, Steve, I'd agree with you. If you looked at your institution and you generally, if you looked the last maybe 3 or 4 years, and you looked at your annualized charge-off rate, and you said, do we have enough in reserves to cover the maybe a year or 2 years? Maybe you're not going to have such a big adjustment. But if you've traditionally been at the low end of your peer group in terms of reserve, you may have some higher amounts. We are expecting that there's a significant number of banks and credit unions. If you put everybody together, I think there's going to be quite a few that will have very little or no impact on their level of reserve.
Yeah. Great, thank you. Next question is, how would you quantify?
Hold on one sec, just one more second on that. And it's something we haven't talked about, but I think it's hugely important, is the human element, right? The same examiners who examined us a year ago and told us that our reserve was adequate, right, as of 6 months ago, do we expect those same people to come in 4 months later and now say it's massively inadequate? We know we're playing the same game with the same people with a slightly different set of rules. And so I honestly do think there is a human element in this, where a lot of examiners might say, we look at your model, your methodology seems to make sense. We agree with most of your assumptions, but we thought your reserve was fine before, and we still kind of feel like it is. So you might want to find a way to get it back towards kind of where it's at today. And just from a practical standpoint, we see that too.
Yeah, and I think that's consistent with what the NCUA has shared with us too, is that, they want to see, as like Paul was touching on, right, that this is going to be a slightly evolving process, right? We want to make the transition, and then we're going to fine tune this thing, certainly moving forward in the first year or two. The next question was, how would you quantify a Q factor for lending policies and procedures?
The point of this Q factor is to adjust from the past to the future forecast. So to the extent that you had, say, a 2% loss rate in a portfolio area, a segment, and you said, hey, we've significantly improved our underwriting, we've brought in, additional people, we've put in more policies and procedures, then you may have a negative Q factor for lending policies and procedures because you've improved those. This has happened historically in the industry as perhaps underwriting standards slipped and got a little looser. And then all of a sudden we had a big problem in the industry. And so people tightened up on their underwriting, improved their process and procedures. So typically the lending policies and procedures is an attempt to acknowledge, have we gotten better or worse in this area, bringing it to today, and how would we think about it going forward? But it is an attempt to have an adjustment, if necessary, for changes, improvements, or deterioration in that area of your institution. So for many institutions, there may be no Q factor for that. You may say, we were always strong in this area, we continue to be strong in this area. But it is an opportunity for you to think about what would be the effect on your loss rate if you improved and enhanced, or you let slip your lending policies and procedures.
Yeah, I think that description and explanation is perfect. And again, another example I was thinking of too, right, is if you move from requiring automatic payments, or just as Paul touched on, just improvements in your process, right? You could see a Q factor change, or as he said, a change in your underwriting standards, positively or negatively, for being more allowance or less accommodating, would certainly warrant a change in your Q factors. Looks like the final question is, what do you think on the reserve for unfunded commitments lines of credit? So we kind of touched on this one a little bit, I think, but Steve and Paul, you want to take that one again, Steve, maybe to start?
Yeah, so we do have a template in our tool. There's a page for the unfunded commitments specifically where we manage that section of it. We can get your gross unfunded commitments from the 5300s. We can extract that data by segment. Of course, the segmentation is not the same as it is for the rest of a loan portfolio, which makes our job fun. But we start with that, and we work with you to net out any unfunded commitments that are considered unconditionally cancelable from an accounting standpoint. If for example, unused credit card lines are typically kind of close to the definition of unconditionally cancelable, right? Any unfunded commitments that are cancelable like that, we can net out. Whatever remains is the net unfunded commitment that we have to manage from a potential from a CECL standpoint. And then we have to jump through a couple mental hoops here, because what they're asking us to do is project long-term potential losses on loans that don't really exist yet, right? So we have to estimate or guesstimate what the likelihood of funding is over a period of time, and then what kind of losses we might see if they were to be funded. Luckily, we have great loss data that we just finished in the other part of the tool to tell us what kind of losses we might see. So really the biggest, most open-ended assumption there is what that probability of funding is. And just like with prepayment rate, there's even less data out there, honestly, good data on some of those industry data on some of those likelihood of funding. So we give you some good default data to work with. The NCUA has done some studies historically on what they call credit conversion factors and their risk weighting calculations, which is kind of their estimate of probability of funding within a certain, usually an annual period. And that's what we start with by default. And if you have better historical data that you can rely upon, then you can modify that. But it's certainly an area that there's not been the most detailed guidance. And as we hear more feedback as we go throughout this year and well into next year, we certainly can refine the tool as better guidance comes along. Paul?
I was just going to say, that as long as you keep in mind, it's a two-step process. You don't have to reserve on all unfunded commitments. You have to consider whether a reserve is required on those unfunded commitments that you actually expect to fund at some point within the forward period. And then whatever that loan gets funded, what kind of loan is that? And so what would the reserve, the allowance calculation be on that? So if you had a commitment for say a commercial real estate member loan, and you knew that historically your loss factor for those loans is, 1%, then you'd say, well, of all the commitments, what's the percentage that I'm estimating will fund, and then 1% of that number. So just keep in mind, we're not building a reserve on the entire unfunded. We're building a reserve on the portion of the unfunded that we reasonably can project or estimate will fund. So it is a two-step process. I agree with you, Steve. It's about as clear as mud, isn't it?
Yep.
Okay, we're running a little bit over on time, but just a few more things. Steve, do you just want to touch on some of these enhancements?
Yeah, so something that I'm sure if you haven't been aware of it yet, you're all probably eminently aware of it now because you're filing your call reports. And the Form 5300s have seen the biggest change in the last week that they've seen in my career for sure, specifically in the areas that are very important to credit and CECL. So we have they've changed the buckets very, very significantly. All those memo items that we used to have are no longer memo items. They're kind of all additive now. So the plus here, the good news is we're going to have some more granular additive loan segmentation data to use from a CECL perspective moving forward, as opposed to the old 9 categories on our charge-offs, recoveries, past dues that are additive, and then some memo items that you don't know where they're coming from, right? Mishmash of buckets. There's going to be 20 segments, and they're all additive, and there aren't going to be any more memos other than, I think, total direct or total participations. So that'll give us some good discrete data. The challenge is going to be that under CECL, we're supposed to be looking back at cyclical level changes, right? Changes in historical loss patterns over a long period of time. But now we're changing the buckets in the middle of a look back period. So there's going to be a significant challenge there in marrying old buckets to new buckets. And that's the work that we're doing for you guys right now. So by the end of this month, by the time everyone's had their call reports filed, we expect to have a new version of a tool up there where all the segmentation has been updated. If you want to see all the legacy segmentation, that'll be in there. But then we'll have some new combined buckets where you can still do the type of trend, long-term trend analysis that CECL requires. But if you go to the next slide quickly here, Sean, that's on the left. Those are the existing 9 buckets, additive buckets for charge-offs, recoveries, and past dues. On the right is the new 20 additive buckets. All that red stuff is brand new. Those are all fields that never existed until this week. So a lot of new data that we'll use. It'll get better over time, but right now it's going to be a little apples to oranges, and we're working with that. Next slide. Just to get an idea of scope of the changes, everything red on this page is new. So we're talking about 80% of all the data that you collect on delinquent loans is going to be new or slightly different than it was in the past. So that's the challenge that you guys face now, and just know that we're facing that same challenge with you today. And then the last slide on that, I believe, again, showing you a bit of how the sausage is made. This is an Excel mock-up that I put together, so you'll see how that summary page of our tool is going to look. Instead of having 9 rows and then a bunch of memo items that are or are not included in above, we now have 20 completely discrete segments. You noticed how it's organized into non-commercial and then commercial. To an extent, this is an extension of what they started doing in the middle of 2017 with the member business rule, right? In September of 2017, we got a bunch of new segmentation on the portfolio that made the call reports for credit unions start to feel a little bit more like the call reports for banks that from the FDIC. And I think this is a continuation of that same trend. We see things like C&I. C&I is a term that we usually use more on, for commercial banks than we have for credit unions as far as a discrete segment. But now we have commercial and industrial loans are a segment. And everything is separated between non-commercial and commercial, but all the commercial stuff is additive in there. So I think in the long run, it's going to be better, but I think they could have chosen a much better time to implement these changes with respect to us all dealing with CECL.
So the next time you see Steve, that black hair in his head will be great.
It's getting there. It's a new one every day. Thanks for pointing it out, Sean.
All right. Well, everybody participated fantastically today. So this slide was not necessary. Just a final reminder, we will again be back at you here in May with another coffee talk session. We will be later this month. Steve will, take you through a more in-depth discussion of CECL Solver. If this is your first time and would like, a deeper walkthrough just on the tool itself, he will do that on April 28th. In between, if you would like a demo specifically with your institution's data, please reach out to us at info@quickrate.com. Give us a call. We'll schedule a time and take you through your information and discuss your institution's data. So I can't thank you all enough for joining us today. I can't thank Paul Allen enough for joining us today. It was fantastic discussion and comments. I appreciate all the questions submitted. We hope you found it all very helpful. I'll just turn it to Paul and Steve for any final comments.
I want to say thank you for inviting me, Sean and Steve. I enjoyed the conversation. Love hanging out with you guys and hearing your thoughts. So thank you.
Yeah, I think I've caused enough problems for today, Sean, so I'll leave it at that.
No, all good. So again, thank you all very much for hanging with us, even though we ran over. Thank you for all the interaction. I hope you have a great weekend, and we will see you next month for the next edition of Coffee Talk. Thanks so much.
Thanks, everybody.
Thank you.
Thank you.